buying the dips, buying the dips. You hear it all the time, right? But what does that even mean anyway? Because a lot of traders, what they do, they'll buy the dips only to find out that there's not really a dip, but it's a crash or a aggressive sell off, right? So how can we prevent ourselves from getting into those traps or pitfalls? And when can we locate the probability of when is a good time to buy the dip? Well, in this video, we're gonna discuss how we can mitigate risk and also find those areas where the probability is in our favor. All right, let's go to the charts. Okay, traders, as promised, specifically we're going to discuss buying the dips, right? So you always hear it all the time, buying the dips, but nobody actually explains exactly how to do so. So on this episode, we're going to focus specifically on how to actually buy the dips with precision. Okay, so we're on the S&P 500, and let's go back to July the 31st, right? Or let's go even further back. Let's go to the 31st of July. So as we can see, at around 2 o'clock, 2 p.m. Eastern time, the S&P closed below the 8-period EMA, which is the red line, and also the 20-period moving average zone. So essentially, what you see is the 20-period moving average, the 20 MA. So what I did, I took the low and the close, and so essentially it's one line. So what I did is I divided the line into two. So you have the low and the close, right? So that's what gives you the 20-period moving average zone. So we see that the candlesticks, right, close below the 8-period EMA and the 20-period moving average zone, and sure enough, we had a landslide. We had a massive sell-off in this area, and it went all the way down to this area. So how would you have known to actually buy the dips in this area? One easy, simple way is to use the instrument that I use is called the CCI. So the CCI looks almost like the RSI, but it is not the same animal. They're both oscillators, yes. However, the RSI is considered a bounded indicator, so it has a limit to how far it'll go. With the CCI, that is not the case. So the CCI, which is set to a period of 14, by the way, is somewhat similar. It gives you the momentum of the move, and also it gives you the probability of where in those areas where the probability of the change of the markets and also the pivot is also involved. So essentially the CCI comprises of the positive 100 line, which is in this area right here, and also it has the negative 100 line and also has a center line. So essentially, when we want to trade the pivots or the pullbacks or the change in direction, what we do is we will wait until the CCI line goes below the negative 100 line in this area, and then wait for the line to touch or go past slightly in the negative 100 area in this area, right? And as we can see, it lines up perfectly with the candlestick. So where we see the cross, that is where we want to enter for a buy to go long. So this works perfectly if you're scalping the markets, for example. Now, bear in mind that price action is trading below the 8-period EMA, the red line, and also the 20-period moving average zone. So be mindful that you're not going to have that super move to the upside where it's going to fly past the zone and continue to go on, continue to go. It's going to be some resistance. So bear that in mind. We will enter the markets in this area right here, in this zone, this area, right? And we'll put our stop loss just slightly below the swing low in this area. So that's where we put our stop loss, and we would probably put our take profit like around here. So we have a nice decent move to the upside with the knowledge that we are going to have some resistance once the price action touches the zone. So this is a really cool way of how to trade the pullbacks or buying the dips, right? So we can see that, for the longest, price action was bullish until we had that massive sell-off around the 25th of July. All right, so that's one example of how to trade the pullbacks, guys. So it's not that complicated, very very simple, and we can look at other examples too as well. Let's go back to, hold on one second. I'm trying to get rid of this paintbrush thing here. It's not let. Okay, there we go. All right, so as we can see, let's find other examples, right? So we're on the 30-minute chart, by the way. So each candlestick equals 30 minutes. All right, so here's another example. This was back all the way back in April, the 21st, the 20th, correction. All right, so this, we had a sell-off, and then around 2 a.m. in the morning is where we probably would have entered for a long in this area, right? And so we can either enter in this area or wait until price action close above the 8-period EMA and the 20-period moving average zone in this area. So that's how we would buy in the markets, buy the pullbacks or buy the dips. All right, and in this area we have another example. We can see we have the massive sell-off, right? And then we would have entered in this area right here. So we would put our stop loss right below this area here, and then we would buy, and then anticipate that yes, we're going to have some turbulence moving forward because it has to go back into the 8-period EMA and also eventually hit the 20-period moving average. And as you can see, it ran straight into it, bounced off, and then tried to push through, but was not successful. And then there was another sell-off again, and sure enough, we have another push through the 8-period EMA and the 20-period moving average in this zone. And this is where you would put in a order to go long. So once it pushes through the 20-period moving average, guys, that's where you want to enter the markets, right? And then put your stop loss right below the swing low in this area, right? That's where we want to do it. So we would continue, and then as this candle closes, we would put our stop loss right in that area, and then so on and so forth, right? And then of course we would have stopped out in this area right here. So that's one way on how to play the markets. So it's not complicated, it's not rocket science. All you got to do is just look at the information that the market is giving to you, and then you would just follow suit and trade accordingly. All right, so guys, thank you for tuning in today and watching this video. We'll discuss further in more detail on the oncoming videos that I'll be making in the future. Okay, so just like, subscribe, and we'll see you on the next one. Take care, guys. Bye bye.